Well, hello and welcome to Thank God It's Friday. This week, we are once again joined by Samir Arora. He's the founder and the fund manager of Helios Capital. And once again, we are taking stock of the markets and what we may expect, not only globally, but also in the Indian markets. Samir, thank you for joining us.
Good day. Good afternoon.
So, Samir, my first question will have to do with the US markets. Well, it is at lifetime highs. But it's pricing in tax cuts, it's pricing in huge infra spends, there is expectation of less regulation, but there is also skepticism about Trump coming through with a lot of promises that he's made. And there is, of course, also the matter of rising interest rates, as well as, to a certain extent, stretched valuations. Now, I'm not saying that there will be a correction in the US, but should there be one, how insulated is India?
But first of all, I think the US market is quite well placed, because there are many parts of the US economy which will benefit from higher interest rates, and particularly their banks and the banking system. There's been a long time since anybody looked at those US banks from a PE kind of a basis. They are trading at 0.5 and 0.7 and 0.8 times book. And so some of the things Trump may do or not do, but higher interest rates will help major parts of the economy. Also, please remember that in the period maybe 2005 to 7 or 8, 7 I think, there were more than 10 or 12, I think 16 consecutive interest rate hikes in the US. And the markets were still up. So don't be overly nervous about the US market. I am quite bullish on the US market. But independent of that, the Indian market is part of a emerging market pack. It doesn't go up and down on its own. It may outperform or underperform that pack, but it normally would not go in an opposite direction to what is happening in our part of the world or in the emerging market part of the world. And so it's sort of this thing that if the US market does badly, for some time everybody will do badly, but there's no need to feel that is the current scenario.
Okay, Samir, so, if the US economy is in a relatively strong state right now, that means a stronger dollar as well to a certain extent. But that also means that we may not necessarily have, the best of the fund flows as far as India is concerned. In fact, there is expectation that we could see tepid flows and which could actually taper moving on into 2017. Are you of that opinion?
Actually, these days we are already getting tepid flows from as far as the stock market is concerned. But I don't believe that the money is a matter of either or kind of a thing. First of all, big picture, if the world is up, if US is up, it's normally very difficult to imagine that we will be down. It is possible that we the emerging markets are all up a little less and such stuff like that. Secondly, a lot of money comes basically from reallocation from fixed income and other places. So there will be many people who will be losing if they have long-term bonds and stuff like that, and they will move to equity. But in general, I don't think that for us, imagine what size we get. Last year, I think we got some $4 or $5 billion. And one IPO in the US is more than that many times. So to get 5-10 extra $billion in an environment where the domestic mutual funds are not like passive or sellers into anybody coming and buying against them, means that even 5, 7, $10 billion can make a big difference to the market per se, just because these days the natural seller which they found in the past, which was the domestic institution, are themselves buyers.
Samir, just to pick up from what you were talking about, I just want to understand if FIs have become a little less relevant in moving the Indian markets now, as you were speaking, given the fact the way domestic inflows from retail investors have been coming in. So, do you believe the domestic liquidity is here to stay, and what could scare these domestic investors away?
Well, first of all, in a big picture sense, this trend has just started. The total flows that we get in whatever 10 billion or even less normally per year from domestic investors into mutual funds, and maybe they invest some part of their own, but say 15 billion, and the savings of India must be, they say 30%, so that's like $500-600 billion of savings, in which, I don't know, but maybe in the past half was gold and real estate and the rest of financial assets. So to think that this 10 billion is too less and that is too much and it cannot go to 15 or 20, particularly when the other two asset classes have become unattractive for various reasons. So that flow can continue. Now that flow can be that flow can stop or reverse if there is a massive correction, if there is a fraud, if something which makes them feel that maybe they were not right in moving. But there are many stories I hear of people who are investing more or less for the first time in their life into equity markets because that money that they had all is in the bank, and once it reaches the bank, we have these friendly bankers who try and push insurance products and mutual fund products, and they find a captive audience because the money has already reached the bank. And it's easy to convince the public these days that gold is not a good investment or that real estate is not a good investment. And just the fact that it has gone through a banking system makes them consider financial assets more, also because the commissions are more. The Indian banks, as you know, are aggressive in selling these things. It can go on a top-down basis. It's not a large proportion. On a bottom-up, there is this impetus just because the money is in a financial system for the first time.
Okay, Samir, there have been a lot of events such as demonetization, which have probably not fully played out yet. Then you have the implementation of GST, which will be coming in, and that could probably have some negative impact on the corporate earnings growth, which has been elusive for the Indian markets. Every year there is some one-off, and analysts keep saying that double-digit growth is going to come in next year. But at the same time, the Indian benchmark indices continue to trade at about 20 times forward earnings, probably one of the most expensive markets globally. So what is really the missing piece here? Why this mismatch?
First is you have to give credit to all of us who always say next year. At least we don't change the views. We are always saying next year or the second half of this year will be a great year. But the first thing is that demonetization, initially even I was very negative because I thought that the positives of demonetization will take longer, whereas the negative was here and now, which was basically stalling of consumption. But it so happens now, we know in hindsight that in consumption, because in October the numbers were so good, it now appears that it basically only may have delayed it, but then the growth impetus was very strong because every company said that by December the numbers at least were massive recovery from November, and in January it continued to be a little better. So even today the numbers overall, if you look at aggregate demand, might be lower, but it means that up to October or in October the real recovery had started, and therefore as of now the assumption is that it has stalled it by a few months here and there, but not permanently damaged it. But the benefit which was, I thought, which will come from demonetization, which is financialization of our market, we thought that over time, over 6-12 months, people would, find that they have less attractive choices in other areas. We did not realize that it would start more or less simultaneously. As even in the November month itself, the flows were very strong. And that has buffered the market and effectively helped discount these things faster, because new money coming in takes the view that this is a good company in a bad cycle, or a good company in a bad quarter, or a good company in 2 bad months. And now we can't argue with that part because those companies are really good. Now coming to your earnings, the reason why our earnings are lower and our P's look higher is because 30-40% of our economy is not producing earnings. These were the metal companies, the PSU companies, commodity companies, maybe real estate companies, and therefore wherever there is growth, people are buying, and wherever there is not growth, they are buying on the basis that one day there will be growth. You can't overly argue with that. It is not overly out of line. If you look at it for the last 4-5 years, other than in 2014, where actually the mid-caps did very well. But if you look at the overall market, I don't think it's up more than 8-10% per year, which is nothing. Yeah. So it's not wild. It has not been a wild rally except in mid-cap stocks.
Okay, continuing with the talks on domestic events, and I'm talking about the state elections now. I came across an interesting tweet from you, and I'm reading it. Instead of watching exit polls, we should exit from watching these polls, and I'd probably suggest that you don't think this is a very big event from the market perspective. I just want to.
I did that. I tweeted that basically because I was only watching NDTV because that's the only channel that we get on a TV. Otherwise, I have to go through an internet and this thing, smart TV. But on that, they were only showing other polls. And in those other polls, there were 5 polls and all were basically a little bit here, a little bit there. There was no real value add from anybody. So that from a market point of view, also, I don't think it's a material thing, but it will be one more bullet point now that if BJP wins as expected now at least, it will be one more bullet point to not have a negative or somebody question our general optimism in life. But if suppose BJP loses UP despite these exit polls, the rest of the world is strong. After 2 days, I think we will forget. Because the ultimate meaning of this election is, does it draw any can we draw any conclusions about 2019? And I don't think we can draw those conclusions. I don't think there is some legislative action that is waiting, which would be completed once we win UP. Oh, you tell me which event is waiting, which needs actually for them to win. It is more a signal and a comfort that the strategy is generally working, that there is sort of Mr. Modi has the pulse of the nation and knows it, and he knows how far to go on various things. But beyond that, there is no real stock market value. But now that they are supposed to be winning, that's, as I said, one more bullet point in our favor.
So Samir, I'm going to come down to picking up stocks. Now, I know that a lot of people out there are of the opinion that right now they're willing to pay a premium for growth stocks. Sometimes not always necessarily for value, but what are the undiscovered areas that you feel that may still offer good potential right now?
Well, I am unlike others. I feel that you don't have to make money out of undiscovered ideas. My personal biggest holding is Google. And do you think I know anything about Google other than what everybody knows, and maybe even less than that? Yeah. The point is, you have to believe, first of all, in a few things. Number one, do you believe that in India, as I was saying, that people are underweight as an overall, number one. Number two, do you believe that compared to the world, our financialization is very, very low? Thirdly, do you believe that our state-owned banks and state-owned general institutions are not able to compete with private sector in any area in which they end up, unless if it's a natural monopoly like, say, some defense company or something? Do we believe that the private sector financial institutions, the private sector banks, which have grown at this pace and various cycles, can continue to do this and gain a market share from state-owned institutions, either because of their service or technology or the fact that people now want to do internet banking, they want to do app-based banking, and then whether India itself today is not growing at a very big rate, its nominal growth rate will be 10-11%, and that is as low as it gets, and that do we believe that financial sector grows at 1.5 times the GDP. Look at history of 20-30 years. After that, the stocks are obvious, but it's not a new stock. It is not a new stock. I own Disney. And do you believe that I actually went and did some research on Disney? I broadly know that Disney has been around for God knows how many years. If you look on Bloomberg, you'll find that from 1989, its dollar earnings, stock market returns are like 13-14% per annum, which is a very high return for any market, would be much better than maybe what Warren Buffett has given for this period. And you know, he owns 4 studios. If you come after 2 years and with the same logic, you are still delivered. You don't have to know more, you have to believe in that. So that when it does not do well, you are not shaken up. The game is not so much as to buy something new, but to have sufficient confidence in it from various angles, to not sell it on a bad day. I think that is the only confidence that is required in life.
Okay, so I'm going to come down to the primary markets, and some may argue that the IPOs that we've seen throughout this year and perhaps the year before that they are not all reasonably priced. And yet there is heavy oversubscription in all these IPOs, which means that there will be little or no allocation to a lot of retail guys. Based on that, what premium should you be ready to pay when the listing happens? For example, something like a DMart, which of course once again has seen phenomenal subscription.
For DMart, I feel that I will be willing to pay, because I'm not applying in the IPO, because it's going to be oversubscribed, whatever, 200 times. So how much should I apply to get 1/200th of that?
Right.
But I'll be willing to pay to this price at 30-40% premium. And that is because it happens to be a unique asset. The delivery and execution has been very good. And more than that, you can imagine that the opportunity set is very large and that it is not easily disrupted. Some other IPOs come and you buy and you feel that it's more like a flip, but this one looks longer term play. But because it is going to be so heavily oversubscribed today, people will broadly not make any money in this process, and also you will get very little. So even if I could say, doesn't matter whatever I get, I'll make some money, I don't like that kind of a small, because it doesn't serve the purpose of a fund. But on DMart, 30% premium, if it lists on 40%, it will be a steal that day, I think.
All right.
But yes, it will list more than that, and therefore we will, in a sense, not have it, and we'll never follow moves after that.
All right. Samir, there's also another IPO that we just ended yesterday, that's Music Broadcast Limited. Any thoughts on that one? Would you really buy that at a premium?
No view. We didn't even read it.
All right, Samir, thank you so much for your time. And just one last question before we let you go. It's been a very busy week, and we're probably staring at yet another eventful week with the FOMC meet next week. And a lot of people like us in India are looking at some light reading for the weekend. So just wanted to ask you, since you're an avid reader, any recommendations? In fact, a lot of Bollywood personalities have been writing these days. Any suggestions?
But I have read both of them, Khullam Khulla, Rishi Kapoor, and this Unsuitable Boy, Karan Johar's book, if you want to read that kind. Otherwise, now I'm reading Howard Marks' book, because he came to India, so you have to be a little bit current with what's happening. Although I didn't get to see him. But his book I'm reading, which also quite readable, called The Most Important Thing, I think it's called, something like that. But they don't need to read, enjoy Holi this time.
Yeah.
Thank you so much for your time. It's always a pleasure talking to you. And as for you guys, it's a wrap on this session of Thank God It's Friday. Thank you for watching, and we wish all the viewers a happy Holi.